Welcome, Rohan. We try into stock market session 7 plus 1, April 6, 2025. How are you?
Good, Eric. How are you?
Good. Welcome back. Crazy market this week. The Dow Jones was down 2,000 on Friday,
Yep.
and I think another couple thousand. It was down like 4,000 within 3 days. So let's just say that's 20%. Sorry, 10%
Right.
off the Dow, which is it's pretty decisive, and that's a pretty big move. I was surprised. I thought maybe it would go up 5 or 10%, but it went down more like 2,000 on Friday. So I was surprised myself. But it can always go lower, and right now it's jittery. Different reasons, but it's people are jittery, and that's causing more selling. So one thing that I want to tell you is that when you have a market that goes down, this doesn't show Friday, but it was down 2,000 on Friday, 2,100 on Friday to 38,000.
Right.
When that happens, it causes margin calls. Okay, do you know what a margin call is?
No.
People, when I tell you, never go more than 30% in margin. 30%. People go 50, 100% in margin, and then because they're borrowing so much money, they only have, let's say, half the cash. When the market comes down, they lose twice as fast, and they come to the point where they have more margin than cash. And then what happens? They get a margin call, so they have to either bring money in to deposit or sell their positions. That's what a margin call is. When somebody's over leveraged, and the broker says, "Hey, your account is over leveraged. You have too much margin. We have to either sell or deposit money."
Okay.
And what most people do, they sell because they're losing. Sometimes they deposit money, but most people don't have money to deposit. If they have money to deposit, they wouldn't margin in the first place. They would
Yeah.
use the money to buy the stock. So they're leveraging. And what happens is, let's say Thursday, Friday margin calls. You get 3 days to do your margin calls. So Monday, by Tuesday, Wednesday, I expect it to drop a little more. Even if it's just even if it's just a dip and then back up, I expect a dip. Let's say by Wednesday, because of the margin calls.
Right.
Unless there's really good news, it's gonna go down a little more. You know.
So
So
do you
we're in a
expect a drop on?
downtrend.
Do
Huh?
you expect a drop on Monday, Tuesday, Wednesday kind of thing, or
I
I
do,
guess?
I do a little bit, yeah, a little bit more, yeah. Not necessarily 2,000, but maybe something where it dips like this, and then maybe ideally, I hope it comes back. It might come back in the same day sometimes, because there's always big money that have real money, Warren Buffett type people who are waiting for that support,
Right.
in their mind, whatever the support is. If you look at the chart behind me, what this has done, taking us back 1 year on the Dow Jones. It took us back to April, 420. I'm sorry. This is the Qs. Let's
It
see.
says April 30th, 2024.
That's 1 year, right?
Yeah, it's 1 year out.
Let me make sure. I think this is the Qs. 424.
Yeah.
QQQ. Let's see. So it's taking us back a year on the price. Yeah, the Qs are 422.67 on Friday, down 28, which is like 6%, which is kind of a lot. And that brought us back. If you look back, if this is the historical price, it brought us back 1 year. It was as
Yeah.
much as 540 as a high,
Yep.
and then just down. And here now we're so here. This is today here, and this is a year ago here. Does that make sense?
Okay. Yes. Yes. Got it. So
Now,
it's basically down to the same price as last year.
yeah. So basically, we lost a year of gains. Now, here's
Yeah.
the thing. This is normal for investor traders. But back in the day, they didn't have consistent income or consistent growth so much. Like, if you look at the Great Depression and then you go into the 40s, the 50s, the 60s, 1970s, the market wasn't making 12% return a year. It only recently has it been doing better and better and being more consistent to where you can say, oh, we're making 10% a year, we're making 50% a year on the tax, we're making 12% a year average. That wasn't really a thing before. So more and more times, more and more years as we come out, we're picking stocks better. The professionals are picking stocks better. More people are investing, and it's causing this market effect where we're getting more of an upswing in the market price. I started trading when I was 18, back in 1988, and I maybe like in 2010, I
Mm-hmm.
hear these young kids saying, "Oh, the market gives you 12% a year, so why don't you just do that?" Like, what are you talking about? The market doesn't give you 12% a year. That's ridiculous. Who said that? What they're doing is they're taking the S&P 500, which is the ideal top stocks, and they're averaging it 10, 20, 30 years, and they're saying, "Oh, the market's doing 12% a year," but that's really not true year to year. And in this case, we have zero return. Okay,
Yep.
and consider, because it went ticks back, and consider that we're not really in a bad economy. I mean, there's worse economies, you know. So I don't really agree with the 50% here, at least not consistently. So you still have to pick good stocks. You still have to do good trades. And these mutual funds that they tout, oh, the mutual fund makes this is the best mutual fund because it makes a return. What they don't tell you, Rohan, is that they have 100 mutual funds, and then they tell you the one they did the best. They said this one did. Look at the mutual fund. This is a 20-30%. And then the moment you get into a mutual fund, the next year down 5%. so so even though the market is doing this average over time, you can never depend on that because, like what happened here, but also in general, we are doing better as an economy, better as a market. More money's flowing in. We have like $56 trillion into the U.S. stock market, considering the Nasdaq, the Dow Jones, the New York Stock Exchange, and even over-the-counter stocks. But anything related to the U.S. And then maybe that's come down a couple. I think they said we lost 2 trillion last week, so maybe it's 54 trillion. But even though we're doing great, we can't rely on average returns in the market. So we have to always pick better stocks and trade better and perfect our art of trading. Okay. And in this case, we went right back to where we were last year on the Qs, and that's why we have to. Now, if we were to cover call for a year on the Qs, we'll be perfect. Because look, it went right back to where it was before. And what we have, if we sell a cover call and say at the money at 424, we have time decay. You see,
Yeah.
and that's what I want you to use as your foundation: time decay, selling the call, selling the put, using the resistance and support, using the support as a buying and the resistance as a selling, right? And picking
Right.
good stocks. Now, questions on that?
No, so like some stocks, which we have purchased at a higher price kind of thing. Um, I mean, it's not super high. It's probably about they are like 15% down from what I bought. Uh, Continue to do covered calls on those.
Yes, if it's only
Think,
50% down, right? We're getting what 5% on pounds here on Tesla, 6%.
yeah, yeah,
So you just lost 3 months of share growth. That's all. You just
right.
lost 3 months. And if you get 5% a month consistently, where will you be on the premium? Just on the premium,
Right.
where will you be at the end of the year?
Yeah, it's like 50% at least, right?
Yeah, 50%. So if the market goes down, the market will have to go down 50%, or at least your stock had to go down 50%. You'll still break even. You still survived. You know.
Hmm. Hmm.
So the theory is you're going to outperform your share growth loss with premium. So just keep riding the cover call, and don't get stuck. Never get stuck in a stock. Pound I know went to 74, right?
Yes.
So just write the 78 or 75 or 79 or 80
Hmm.
because you're giving up some share growth loss, but you're getting consistent premium, and that's the goal. Consistent premium is going to win the day.
Okay.
You
Okay.
can do the same thing for dividend stocks, but dividend stocks takes like 10 years because it takes, if you're getting 5% a year, well, different. That's a different argument, but you can do the same thing with dividend stocks, where you can build up your account to where you can double your investment, bring your investment back in dividends. That takes many years to do that. Whereas recover calls, you can do it in months. Okay, maybe 20
Yeah.
months, 5%, 20 months, 100% return. Follow me?
Right.
So
Yeah.
focus on that. And remember, don't get stuck to thinking, oh, I bought Palantir at 120, so I can't sell the 75 call. You can certainly sell the 75 call.
Yeah.
And by the way, you have no choice because Mr. Morgan's looking over your shoulder and he's going to give you a scolding if you can't make money every month, every week. Question on that.
No, that sounds like a good plan. Going like proceeding with that approach on a month-to-month basis, because right now,
Patience.
yeah. Is there like do we so of course the covered calls that I bought are monthly, so they are all most likely till April 17th, right?
Yes.
And so do we wait after the April 17th, let's say it expires? Do we wait for the market to come up slightly, or just continue with that immediately, pretty much?
Sometimes I let them expire. That's the first lesson. Let them expire because you're not giving any money back. You're getting a full return. Okay.
Right.
But what you could do, like the last day where there's the least amount of premium left, you can buy back your cover call and write the next one
The
for
same
May.
day.
If
Yeah.
it's if it's a proper timing,
Hmm.
I would never write a cover call when we're down 2,000 because that's not getting the best return. I would write a
Yeah.
cover call when it swings up, unless you're doing it is in a desperation mode where the market's sliding, your stock is sliding, and you just need to have some protection, and that's
Right.
okay. Ideally, you don't want to have to do a trade in those conditions, but like they talk about the octopus. We gotta be a chameleon. We gotta change with the market. The market
Right.
trend is down. We gotta trade down. Market trend's going up. We gotta trade up. Did I talk about the chameleon with you?
No.
I didn't.
No.
The chameleon. As traders, we're chameleons. As successful traders, like the chameleon on the branch.
Yeah.
His power is he can change his
Camouflage.
color.
Right.
There's also an octopus. I call it chameleon octopus. It's in the ocean, and when he goes on a black rock, he turns black.
Oh, okay. Yep. Yep. We've spoken about this. Yes. Yeah. Yeah.
Which okay. So and then when he goes on the white coral, he turns white. So
Right.
we have to change with the direction of the market. We talked about the rich man's cover call, correct?
Yes.
How you go in the money.
Yes.
How you realize that, like Tesla right now, it went down to 240, down 30 points or whatever. But if we wrote to 200 Tesla, we're protected all the way to 200. We still get premium, correct?
Yeah. Yeah.
But let me just look at that real quick. Um, like you're talking about, you're doing some leaps, okay? Let's say today, right now, today, you want to adjust your trade. You think Tesla can go down a little bit more, which it probably can. Okay, Tesla I have here, 239 down 28 for Friday. Okay,
Right.
now probably I'm just gonna look at the 20-day. This is what I have on the 20-day. Okay,
Yep.
actually it's still up. It's still up because the low's here.
Yeah. 227. Right. Yeah.
Yeah,
It had gone
uh,
down to
it, it
220.
it might swing up, but right now it's going down.
Yeah.
So it could, like, maybe I have some margin calls. It can always go lower. So if we just turn one of our trades into a 200 leap to protect us in 200, can you consider doing that? Let me pull it up. Okay, this will protect you. Okay. Let me go down to. Oh, by the way, Tesla opened up the third year, 985 days, December 2027.
Okay.
Oh, let's do that one, just because it just opened up. So Tesla opened the December options, 985 days. And if you look at the 200, it's paying 116 by 120. Can you pull up the Tesla option for December 2027, 985 days. 200 strike is paying 116 by 125. Let's just say 120 limit, right? 120 limit on the 200 strikes going to pay us from 120. I'm sorry, from 200 plus 120 is 320. So give us 320 price for 3 years out. So that's a nice return. Let me do the math on that. Stock price is 240. We're getting 120, but we're selling a 200 call, which is rich man's cover call, deep in the money, to protect us all the way down. It goes to 200. We don't lose any money. Tesla goes down 40 more points, which it could. Okay, it might not, but we can't. We can't afford not to have that, not to have some protection on the downside. We know how to do these cover calls. So I'm going to do, if they give us 120 plus 200, 320. So 240 price, 320 minus 240 price. We still, 320 minus 240. We still have 80 points premium, 80 points profit.
Right.
For 3 years. Okay. So actually, yeah, almost 2.5 years. So we do
It's 3 years
80.
almost.
Yeah, almost. We do 80 divided by our share price currently is 240. 0.33 repeating percent return.
Right.
What I'm counting is I'm counting the share growth loss of 40 points plus the premium of 120 is 80.
Right.
80 divided by premium divided by the investment of 240 current price, 33% return, and that'll protect us all the way when it goes all the way down to 200.
100, yeah.
That's deep in the money. Rich man's cover call.
Yeah.
You could also sell the put at 200. You could also sell the 200 put. Similar situation. We don't think of it. Well, I don't know if it might go down there. It might not. But you don't mind taking the stock at 200. 200 put. Let me see. Let me check that price. It's paying. So it's paying 59 by 63. Okay.
Right. Yeah.
Let's just say 60 limit.
Yep.
Okay. 60. Let's say 61 limit. Let's do the math. And you're taking it at 200, so it's a different math. 61 divided by 200. 61 divided by 200. 30.5%. Similar return.
Right.
So, and on the naked put, you're using less requirement. So it's probably more. On a cash cover put, it's 30%.
Yeah.
On naked put, they're not going to really hold 20K because it's naked. They're going to probably hold 10K. So really, this is going to be higher return. But you do have to have the cash to take the stock. So I'm just going to use the maximum maintenance. So on my notes, I'm going to write down rich man's cover call. You can also do the 1 year if you want to. It's better in the sense that the time decay is better to do 1 year. But I'm just showing you 3 years because it just opened up the opportunity for 3 years. I'm going to put 200 Tesla. I'm going to put 80 premium, which is 33% return, 33.3. And then rich man's naked put, which is, in this case, the puts are out of the money. The calls are in the money. Rich man's naked put at the 200 gives you 61 or 30.5% for a 3 year, 985 days. Okay? So that is pretty beneficial. If very decisively and maybe even lower. You can't afford not to have this protection. If the market was going up, it went uptrend, everything's great, the market has been bullish, I probably wouldn't go in the money. I would probably go at the money or higher, like the sweet spot. But because we have to change, like the chameleon, we have to write the lower cover call and the lower put.
So would it make sense to do a put rather than a covered call on this because we expect the Tesla to go up in those 3 years, right?
Couple things. First of all, try to maintain your shares because the shares actually are kind of paramount for different reasons. But if you have, let's say, I have X shares, try to keep those. A naked put would be an addition to that. Okay.
Right. Yeah.
I wouldn't just sell 100 shares at the market and then do a naked put. I wouldn't necessarily do that.
No,
But
no,
that's one. But if you're looking at managing your account and you're looking at it as a naked put better, well, it's better in some cases because if you sold 100 shares and then you just sold the naked put at 200, for example, on the leap, technically you are still getting that 6,100 premium. Okay, all premium, by the way. You have a nice buffer. So in a sense, it's actually better because you're taking you're leveraging better. You're getting a nice return for less money if it's a naked put. But I don't like selling my shares unless I have to.
no, there's no, so we can do continue. So let's say if I have Tesla, right? We continue to do covered call on the Tesla, but if we have that additional money that I might get from selling the covered calls and all,
Yeah,
use that money to do,
yeah. If you sold a covered call today on your Tesla, just like 100 shares was let's say by April,
right,
you're gonna come out on the monthly. 100 shares is unimpeded, is open. Then let's say you did a 3 year leap or a year leap, same difference, 2 years. You just pick one, okay? You're gonna get extra money, and you can use that money. In this case, let's see, it's paying us 80 points. It's $8,000. Okay, so on the 3 year, it's almost enough to do a naked put. Matter of fact, if you have 100 shares Tesla today and you sold even the 200 in the money protection. Now remember, when you sell that low, you're not getting any share growth.
yep,
So if Tesla were to go to 2, 3, 4, 500, which it could go, and you still have that, you never traded that cover call, the deep in the money cover call, you would only receive your 120 premium minus the 40 points of share growth loss, 80 points, $8,000. Okay,
right,
maximum. But $8,000 is a 33% return, and it's enough to buy to maintenance for a Tesla naked put. So yes, so because I'm counting 200, right? Divided by 2, 10,000 maintenance because it's naked put half, and then 8,000 is almost 10,000. So you basically have enough for a naked put.
right.
So yeah, if you want to turn some money into naked put, I would say that's a good deal. Either on Palantir, Tesla, or even I1Q. I1Q went down, but it didn't go down that much. It went down to 20.
Yeah, yeah,
It's now it's creeping back up. I saw IonQ at it was very and they created their first quantum computer, or at least
yep,
they're selling a quantum. You heard the news.
yeah. I had the news. Yeah.
2068 IonQ, and then on the 20 day wasn't doing that bad. On the 20 day we have his IonQ 20 day.
Yeah,
So still up, it's still up.
yeah,
And look at this resistance.
yeah,
And here's support. It's going into support actually. Okay, so whether you do an IOQ, Palantir, Tesla, or just take your pick, you're going to have some nice income. And there's no need to write the higher cover call because the market's not going to just shoot up right now. You want to protect yourself from the downside. So in the money calls and also out of the money puts, lower puts also.
got it.
Questions?
Sounds good. Right.
Okay, you want to tell me you did some NVIDIA cover calls. You want to talk about that?
Yeah, so I did something like Richmond's covered call for NVIDIA, where I went deep in the money on Monday at $85. Um, I got a premium of 20,
Nice.
was at a premium of $20, I think, or something like that.
1 year out, 2 years out, how long?
1 month out, I think I did.
Oh, monthly. Okay, the
Yeah,
video.
yeah,
Rich Man CC. You sold the 85.
yeah.
You got 20
Eight-
points.
Yes.
And then what is the option now?
So on Friday, when it went down further, like to $93 or something, I bought the call back, and I
Oh, you
got
bought it back.
600. Yeah, I bought it back. And I made $6 for it.
You're trading. You sold it for 20, you bought it back for 14.
Yes,
Made $600.
yes,
So are you getting your money's worth from this course?
yeah.
Just think if you didn't have to work and were just all day being the stock market trader, how well you would do.
I consider that beginner's luck.
You're humble. That's even more impressive. You probably do have a knack for trading, from my experience, because you're doing these trades as we teach them, and they're getting the results. Well, I would wait because I think we're gonna go lower.
So that's what I
Um,
was not sure whether to buy it back, or should I continue to wait. I thought, okay, $600 in 1 week, 5 days, which was good enough. So I thought, okay, let's take it and move on.
we went back a year.
Yeah,
I mean, went back a year on the Nasdaq on the Qs. So now here's a year in the video. Okay, a year in the video would take us back to 75, but I'm not saying it's going to go to 75, but it could go to 75. If the video is outperforming the market, it won't go to 75. If it's the same as the market, it'll go back down to 75 or lower. So it already broke the support here. This broke the support here. So the
yeah,
next support is about
yeah,
90.
90, right? Yeah,
And then below that is, if it really dips, it's going to go to 75. So what I would do, I would just put, you bought it back, I would just put the call back in place. Matter of fact, why don't you just put it 3 year? I'm just saying that because you'll get more money and you'll have some ammunition to do more trades. Let me look at it. Okay. You can do the monthly. That's up to you. But I would, if you did the 3 year, if you did the 75, which is just the support for the year support, that's in the money, correct?
yes,
The 75 call, I'm getting for the 3 years out in the video. I'm getting 42 by. Oh, look at this, 42.80 by 42.85. 5%, 5 cents bit ass. That's awesome for overnight. So wow. Okay, so 42.80. Okay, for the 75, which is the last support. That's how I look at it. 42.80 for the 75. The video right now is 94.31
so going
minus
so you-
7. Go ahead.
Eric, you're going 3 years out, is it?
Yes.
What's the date? December 17, 27.
Yes.
Okay.
Yes. Friday it was down 7.49 to 94.31, which is a lot. 7% down.
Yes,
Okay.
yes,
So that's considerable. However, if you're at the 75, which is 20 points in the money, that's 20 points share gold loss, 42 premium, 22.80 gain,
yeah,
22.80. Still, that's a huge profit. Let's do the math. The current price, 22.80 divided by the current price of 94.31. If you did the 3 years, you got a 24% return, and you got 2,200 money back the same day. 2,300, 2,200. So whether you do the monthly, if you did the monthly, I'd go at the money or in the money. Let me see the monthly. But if you got 2,200 for each NVIDIA contract, that's enough to do an I 100 shares I1Q. Just
yeah,
thinking, you know.
yes,
But if you did the monthly, I would go. In this case, you know wait till April 17th or do it now on the monthly. Which should I look at 30
So
days?
monthly, like 30 days, 33 days, like 9th May is what I was looking.
Okay, so 9th of May, 95. I'd probably go to 90, a little bit in the
Right.
money. And
Mm-hmm.
I get 11.75 by, let's just say the 90 is screwed up. It's not giving me the right. But let's just say $12 on the 90. Okay, that gives us 102 price, and 94 plus 102 is still 770 premium.
Right.
Is that right? The 85 is paying 15. That would be a 105. No, that'd be 100, right?
Yeah,
That's
it's
still
like
6
100.
points.
Yeah.
The 85 is paying 15, correct?
85 is paying 15, correct.
So that's 100 price, correct?
Yep.
So you're still getting 570.
Yeah.
Even that one is a nice one.
So I'm going,
5.7 divided by 94.31. 6.4%. Even in the money, this is amazing. This is not normal. I think the options are really hot in the video. Also other stocks. So whether you do in the money on the monthly or going 3 years out, I go in the money because we're gonna probably go down a little more, and you always want to be protected on the downside.
right.
However, if for some reason we just start going up, and Trump makes it, Powell lowers the rates, the tariffs balance out, April 9th comes around, everyone's still alive, start going up, then you're gonna want to wish you were a little higher. So
Yeah.
don't just take my word for it. Do your research, and maybe I say pray on it, believe in
Yeah.
God, because we need some help. We're guessing. We're like drawing this as what I like point arrows where we think it's gonna go. We're not sure for sure where it's gonna go.
Yeah.
We never know where it's gonna go. So we're just using our intuition, using our charting system, our trends, and we just taking our best. We're perfecting our art of trading. We're just doing our best, using our best judgment. So don't go too low, but I would go a little in the money, you know, on those, and look at ideally maybe making some room for a dividend stock, even in your trading account. You said you bought
Right.
Starbucks.
Yes, I did buy Starbucks. I
Yeah,
think I bought.
Starbucks was down 11, which is a lot. But you know
Yes.
what? Even if you look at Starbucks, I'm gonna show you Starbucks. I'm gonna show you something. This is what I saw when I saw Starbucks.
I mean, I bought
Because
like
I'm
very
what?
small shares because I didn't have so much money left in the account. So I bought like 10 shares or something like that to
Do
start with.
you have any margin right now in your
I
account?
might have margin. Yes. Yes.
There's
Yeah.
Starbucks. See the gap up here?
Right.
It's still higher than a year ago. The year low I have 71. So it's still higher. Even
Yep.
on the down Friday, even on the down Friday was down 6, down to 82. It was down 11 on Thursday and down 6 on Friday. That's huge. So I think that's an over. I don't like to look at the news too much because the news is kind of. I look at the technicals. This is overextended down.
Right.
So I would look at this as a buying opportunity. It's still an uptrend for the year. You can't complain.
Yep.
When you're worried, if you want to worry, is when the stock is going this way, and there's no, so they're breaking down all the support of all these broken mountains. These are we're still healthy. We're still a healthy market.
Yep.
So yeah, I would buy here and build up, maybe get more shares. If you to protect your account, maybe sell some of your techs and put more in Starbucks and maybe another dividend stock. I'm just recommending you to balance it out. I understand that you have dividends in other accounts, but it's not the same because you still have to protect each account, and you don't
Right.
want to have, like, remember the drawdown. it's going to hurt you more on the downside. If you lose 50%, which if you lose the 50% in your account, you need 100% to get it back. Correct?
Yeah.
So you want to protect your drawdown. Buy some dividends, put some deep in the money calls. Do you want to talk about the put hedge?
Yes, we don't. Yes, we discussed that last time. I did do a put transaction last week.
Tell me about it.
Um, so I did a put on Hood.
And did it make money?
Yeah. I did
Dude,
a.
you're an advanced trader. My goodness.
No, I'm learning from you, Eric. Uh,
Uh,
let me
now
just open my account
now
again.
Hood is down on the 20-day, and then let's look at the year. Interesting.
It went to $33.
Oh no, I have the spies here. Hang on, let me look at. I'll look at the spy.
Okay.
On the year,
So
again, we're doing good because the year is $13, so it's still a nice uptrend.
yeah,
I think the support's at 30,
but the thing is, when the Hood dropped to 39 or something, that's when I did a put for $34 for a month out.
and then what is the value to put now?
Right now, I think it's about 33 and a half or 34. I think it closed at, 1 second. Where it was at? Closed at
What did you buy it,
23.
and what did you buy it at? What is it now?
So the premium I got was $4.
Did you
The
close it?
premium, no, I did not close that.
So you paid $4.
No, no. So I sold a put.
Oh, I thought you bought a put.
No, no, I did not buy a put. No, no, no. I
Remember,
haven't bought one.
in the put hedge, we so because if you sold a put, you're long. Okay,
Right, right,
if
right.
you bought a put, you'd be short. Okay,
Oh, yeah, I did not buy a put. No, 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 I did
but you
not buy.
sold a put for four.
For a strike price of 34 and I got a premium of $4.
Wait, okay. So when it was 39, you sold the 34 put. You got $4.
That's right.
Nice. And then what is well? You want to take the stock at 34? Because
Yeah,
that's
I
what's going to
mean,
happen.
that's right. I mean, and
Maybe.
but then I'm still covered for like $4, right? So
Yeah, your break even is 30, right?
$30, right?
Yeah, and I'm looking at support here at 30 back in November. So you're
Yeah,
okay. You'll be okay.
yeah.
Um,
Because that's where I was seeing the chart, and I thought the support was at 30 because based on, we discussed support and resistance last week. So I thought support is at 30, so let me try 34. And then of course it dropped further. I should have waited and done the transaction, but yeah.
if you want to go far out in hood, look at the 3 year. On the hood is showing me January 27th, 2027, 649 days maximum. So on this one, what I would do, the support, let's say we'll say we're gonna go from 30 support. The 30 is paying $15 by 15.65. Even at 15, you're getting paid to 45 share price for January 2027.
Yeah,
645 days out. So if you were to sell a cover call deep in the money at 30, you get 15 points, which is 450 share growth loss, and 50 points of premium is 1150 return.
yeah.
So let's do the math on that.
I get like $10 share growth, right? With that.
11, I'm counting 1150. Is that what you're counting? And then 3450.
Correct, correct.
Look at this. Exactly again, 33.3% return.
Yeah,
Do we do that right? If I look at the 2 year on Hood, I have a 30 call for 15 by 1565. Let's just go a limit order. Can we go a limit order at 1550?
Yeah,
So write the cover call for 1550 for 2 years out, and we have a share growth loss of 450 because we're selling the 30.
right.
But it's 1550. We sell 11 points.
Yes,
So 11 divided by 3450, 31.8%.
yeah,
So pretty good. And then you can also sell the put, which is, say we sell the put for 30. Say we do a 30 put, it's showing me the 30 put's not. Maybe you can get, I don't know, 8. But
yeah,
that's 3 years out. Let's do monthly. Let's go monthly. May 9th, the 30 put is paying 260, and the 30 call is paying $7. So those two are good on Hood. So the cover call for the 38 for 7 for May 9th. I'm sorry, be March 9th. Oh,
yep.
May
March
9th, May 9th,
May
May
9th,
9th, May
right?
9th.
May 9th. Yeah.
And then selling the put for 260, 270 for the 30 put. To support the 30. Now, when I actually did you buy a put, I meant I wouldn't buy a put on Hood or NVIDIA because these are outperforming stocks. I would buy a put on the SPY, or the
Okay.
QQQ, and that was setting up your put hedge. Can I review that real quick?
Sure.
Going out 1 year, okay. Let's say for the SPY, that would take us to March 2026. Um, they have they have May, so that's close enough. So wait, hang on, that's not right. They have March, 348 days, okay, and you go 30% in the money, okay, or 30% away from the share price. So 505 minus 150, right, is 350. So now we buy 350. 350 is I'm showing $8, 803 by 834. So 1 year output, 150 out of the money, which is the 350 price. And I get that, always give yourself a 30% correction, or 30% away from the share price. 500 minus 30%, 350. Does that make sense? Is that right?
Yeah. Can you
And
go through
then,
that again, please, Eric? Sorry, I was just
well,
trying to figure that out.
when you buy puts a year out, I
Yeah.
go 30%
Okay. And
lower
then
than the share price. So 505 times zero point 0.7, 350. Oh, okay. 353. Same difference. 350. Okay. So you buy the 350 put, buying a put, not selling. Okay. And it's gonna cost $834 for one put. Okay. And
okay.
you're establishing a put hedge. It's like fire insurance. You're buying a put. You're going long on the put. It means you're short the position, and you want the stock to go down. In this case, you want this position to go down. And when it goes down, these puts will go up in value. But the maximum you can get on these puts is, if you look at the puts at the money. So you look 1 year out, 505. These puts can go to about $40. So this $8 put could be 5 times at the most. Okay. The way you know that is because you look at the price at the money, at 505 price
Uh-huh.
at the money a year out. They're $40. So when you go in the money, or actually out of the money for the puts, to 350, which is what you're buying for fire insurance, they're $8.
Right.
So they can go maximum of 5 times.
Okay.
At least if it's 30% return. They can go more if it's more.
Right.
But I mean, a 30% drawdown, 30% correction from here, from today. So that's there to lessen your loss. It reduces your chances of losing. and it protects your long positions. If you do a 5% in your account, it'll be 100K, put 5K into SPY puts 1 year out at 350 strike.
Got it.
And if it's 5K, $800, 5,000 divided by $800, you have 6 contracts you'd buy, and that would protect you on the downside. And you're just basically like a mutual fund manager. You don't have the luxury to lose money. So, the market turns down, you're going to have some protection. Will it turn down? Probably more, a little more.
Yeah.
Another trade I want to teach you, not today, but I want to mention it because we're getting towards our time, is when you have a shares and you sell a call on top of it, and it's in a concept for that, which is a cover call, getting back the money on a cover call, and you sell it and you sell naked put, you get back money on the naked put. You understand what I'm saying?
Yeah. Yeah.
What you can do when you have that, when you have a call, when you own one call, not selling a call, when you own a call, when you buy a call, you bought a call option before,
No, I've never bought a call before.
and you never bought a put before.
I've never bought a put before. I've just sold. I've just done selling of covered calls. I'm
Well,
selling.
you're in the right. You're in the right mind frame because selling is the best one. Selling is like being the casino, the house at the casino,
Yeah.
because you're bringing in the time decay, you're bringing in the money, and you're just waiting for the to expire. But if you wanted to get aggressive, and you probably want to do this put hedge at some point, even if it's only a few contracts, you're going to buy a put.
Hmm.
Buy a put a year out, 350 on the SPY, or and you want to buy a call. Now you're being aggressive. When you buy a call, you think stock's going to go up. So instead
Right.
of selling that call, you could buy that call. This is buying option. Most options expire worthless. Most of them. So be prepared for that. But if the bottom put the market moves down, that put will go up drastically. Maybe 5 times.
Yeah.
Buy a call, and the stock goes up. That call will go up 5 times its value, and that's where the greed comes in.
Yeah.
When you're buying calls and puts and you're getting 100% return, 20% return, 5 times your money, then you kind of like lose your mind. Some people, and then they go broke because they buy too many, and then they go to zero. And then if you want to tell me about somebody who lost all their money, it's basically buying call options or buying puts because this is the greed when greed factor comes in. But I know you're a wise man, Rohan, and you have the book, The Ancient Art of War, and you're not going to get greedy. You're not going to blow your whole account on buying puts or calls. But maybe 5% is okay. Write it down. 5%. Buying long calls, long puts, and being short on the put side and being long on the call side. I mean, puts for Tesla, Nvidia, IONQ. I'm sorry. Yeah, whether puts or calls. Calls on Tesla, IONQ, Palantir are very expensive. So it's almost like when you buy that call on the put, you're paying such a premium, a high premium. You know, the time decay is about 5% a month, so it makes more sense to sell them. But if you see this downtrend, if you think we're going down, if you could buy some puts, and if you think we're going to go up to the same point, you think we're going to go up on the stock's doing great. We saw the first quantum computer, and there's an uptrend, and the stock is hot. But you can certainly buy a call or two, and you can see your return. 50%, 100% return, 200% return. And then you can just close it at your at profit.
Got it. Yeah.
So questions. We're getting towards the end. I've been talking too much. Sorry.
No, no, this is all good.
I want you to talk more. I wanted to talk about the distribution of income today, but most of this is going to go till next session. But let me touch base on it, can I?
Yep. Yep.
When we're managing our account and we're retiring the stock market, we have to manage our money properly. We have to have account management, money management.
Right.
And distribution of income is designed that you put your money in the right places. So at 100%, let's say we get, how much did you get for your profit for your last trades in was it Tesla? You sold the option and bought it back lower.
Right. I mean, so I got about I think when I did the leap, I got 10,000, but approximately, with selling covered calls, we make about 5,000, 4 to 5,000. Uh,
Let's say you have 5,000 income. Okay,
right.
let's say
Okay.
your month is 5,000. Okay,
Yeah.
um, you wanna be able to. This is how I do it. I'm teaching you.
Hmm.
Tithe is 10%.
What
You
is
know,
10%?
tithe, Tithe.
Oh,
You
okay.
understand the concept? You ever donate money to the temple?
Uh-huh. Yeah.
Ever help people in need?
Yeah.
Uh, it's like a spiritual.
Hmm.
You're obligating the universe. You're giving back. Okay,
Yep.
so tithe 10%. Number two, taxes, 20% taxes. You're expected to pay taxes on your income, so
Right.
put aside 20%. If 5K, 20% is $1,000 because you're expected to pay tax on that.
Yeah.
Next one, withdraw 10%. I'll tell you a story, not today, but of a soybean trader who, friend of mine, he traded his account to $1 million on the soybean market, on the commodities market, and he's doing great. He was happy, high on life. He has $1 million in his account. He's doing trading soybeans. I talked to him maybe 9 or 10 months later. He lost everything, totally went broke. Okay, and he told me, man, I didn't pay my mortgage off when I could. I could have paid my mortgage off. I didn't pay it off. I had an opportunity. So the lesson there is when you're making money, you have income. Take some money out and have something to show for it. Okay, so take 10% out of your profits and put it to your savings. Put it to your child's college fund, or you can buy back silver or gold coins. You understand the concept? You're taking money out of your account because you have something to show for it. All those trades in your favor. You look back and say, this is what I did." You can buy
Right.
yourself a new computer, something that you have to show for it. Understand?
Yep.
So you're not just leaving everything in there and building up. You're taking some money out consistently from profitable months, so you can put it in, something like gold coins. You can buy Bitcoin if you want.
Yeah.
So 20 taxes, 10% tithing, 10% withdrawal, and then 10% to reinvest. Meaning you're building your account up higher every month. So if you got 5,000 and you're putting 10% to reinvest, you always have $500 more. You reinvest the 500, leave it there in the account to build up every month,
Hmm.
and then the rest of the money is 50% is left. 50% you can live off that amount. You can spend it, live off it, pay bills, take your wife out, take your kids out, Disneyland, you know. But you really can't spend 100% of your money you make, can you? Because you got what? You got taxes, you got tithing, you got to
Right.
reinvest, you got to take some money out to show for it, maybe in savings, kids' child's college fund, reinvest 10%, and you can only spend 50. This is like an example of financial intelligence. So when you were wanting to make 5K a month, I did a trade for 5K a month. By the way, your homework next week is to do a trade to make 5K. Can you do that?
I think so. I can try.
On paper, on paper. Okay.
Okay. Okay. Yeah.
And then you can put it in play later. But really, if you want to make 5K, you really need to make 10K. You want 5K a month, you really need to make 10K because you can only spend half, right?
Yeah.
So
Yeah.
maybe you just make it for 10K because that's what you really want to do. You want to make 10K a month. So your homework is to do a trade to make 10K. I don't care if it's in Palantir, if you split it up, Tesla. But make it so it's a reasonable trade. You have this much money. You do this make a put. You just cover call, and here's what you need to make 10K a month. It makes sense.
Yeah. Yeah.
You're only spend half because we can only spend half the money. We can't spend all.
Yeah.
And you're gonna put 20% taxes, 10% reinvest, 10% tithe, 10% build your account, and you can spend 50. So then you really and then you make 10K, then you can spend 5K, and that was
Right.
your initial goal. Spend 5K. Make sense?
Yeah. Yeah.
And if they just told us this in school, we'd have so much financial intelligence, you know.
Yeah.
But they barely even tell you how to manage a checking account in school. They don't teach you about credit. They don't teach you about stock market trading. They don't teach you how to buy your first income property, do they?
Yeah. No. No.
They teach you. They set you up to be a worker bee. Work in a big corporation, they get a what? Job.
Yeah.
Questions?
No, Eric, it was a good session.
Call
As
it a win.
always. Yep.
Thank you, Rohan. I'll send you the recording when I get it. Appreciate you.
All right. Thank
Text
you.
me back with questions. Oh, I'm gonna call you later after. Okay.
Yeah. Sounds good.
All right.